Most people know that stocks and bonds are both types of investments, but do you really understand how they work, how they generate income, and what risks they carry? In this video, we'll explore what really separates stocks from bonds, starting with simple explanations and ending with a comprehensive comparison. Before we dive in, a quick disclaimer. This content is for educational purposes only and is not financial advice. Let's get right into it. First up, what is a stock? Also called equity, a stock represents actual ownership in a company. When you buy a stock, you become a shareholder. You own a small slice of that business, its assets, its profits, and even its decision-making if you hold voting shares. Stocks make money for you in two main ways. Capital gains. If the company performs well, the stock price rises and you can sell it for more than you paid. Dividends. Some companies share a portion of profits with shareholders as regular cash payments. Not all companies do this, especially fast-growing ones that reinvest profits to grow further. Visual. Animation of a roller coaster to symbolize stock volatility. Stocks are famously volatile. Prices change based on company performance, industry trends, the overall economy, and investor expectations. For example, imagine Sarah, a 25-year-old graphic designer. She buys $2,000 worth of stock in a tech company she believes in. A year later, the company launches a hit product and the stock jumps 40%, giving her an $800 profit. But it can go the other way too. That same stock could drop 30% if the company underperforms or the market turns down. Because of this volatility, stocks carry higher risk, especially short-term. Now let's talk about bonds, a very different kind of investment. A bond is a debt instrument. When you buy a bond, you're lending money to the issuer, which could be a government, a corporation, or a municipality. In return, the issuer promises two things: interest payments, called coupon payments at regular intervals, and return of principal, meaning you get your initial investment back at a future date, called the maturity date. For example, if you buy a $1,000 bond with a 5% annual interest rate, you get $50 every year. After 10 years, the bond matures, and you get your $1,000 back plus all the interest payments. Simple and safe, right? But here's where it gets interesting. Even if your interest payments stay fixed, the market price of a bond can change because of interest rates. Take our 5% bond paying $50 annually. If market interest rates rise to 6%, new bonds pay $60 a year. Your 5% bond looks less attractive, so its price drops. Conversely, if rates fall to 4%, your bond paying $50 is more appealing, and buyers might pay more than $1,000 for it. The rule is simple. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. This happens because the present value of future payments changes with the discount rate. Bonds are generally safer than stocks, but they're not risk-free. Watch out for three main risks. Credit risk, the issuer could default and fail to pay you back. Interest rate risk, if rates change, your bond's value may drop. Inflation risk, if inflation rises faster than your interest, your purchasing power decreases. Let's compare stocks and bonds. Ownership, stocks make you a partial owner, bonds do not. Income, stocks pay dividends or offer capital gains, bonds pay regular coupons. Return potential, stocks have higher long-term growth potential, bonds are steadier. Risk, stocks are volatile, bonds are generally lower risk. Smart investors use both in a strategy called diversification. Younger investors often favor stocks for long-term growth. For example, 30-year-old Mark uses an 80% stocks and 20% bonds portfolio for retirement. Older or conservative investors lean toward bonds. 60-year-old Jane, retiring soon, prefers a 30% stocks and 70% bonds portfolio for steady income and low risk. This balance is called asset allocation, and it's key to matching your investments with your goals and risk tolerance. Thanks for watching. If you found this explanation helpful, hit like, subscribe, and ring the notification bell so you don't miss future videos. See you next time.